Hello everyone, and welcome back to the channel. Today, we're diving deep into a topic that can feel like learning a new language, but I promise, once you get the hang of it, it can completely change how you view the markets. We're talking about technical analysis and, specifically, how to use it for pattern recognition in price charts. Now, I know what some of you might be thinking. Lines on a chart. How can that possibly predict anything? And that's a fair question. Technical analysis isn't about having a crystal ball, it's about psychology. Every tick up and every tick down on a chart represents a decision made by a real person, a buyer or a seller. Over time, these collective decisions create patterns, reflecting the constant tug-of-war between optimism and pessimism, greed and fear. By learning to recognize these patterns, we're essentially getting a visual readout of market sentiment. It's a powerful tool for identifying potential opportunities and managing risk. So, where do we start? Let's begin with the absolute foundation: support and resistance. Think of these as price floors and ceilings. Support is a price level where an asset tends to stop falling as demand, or buying interest, is strong enough to overcome the selling pressure. Imagine a stock is trading at $50, drops to $45, bounces back up, then drops to $45 again and bounces. That $45 level is acting as a support zone. It's where buyers are consistently stepping in, saying, "I think this price is a good value." On the flip side, we have resistance. This is a price level where an asset struggles to break through to the upside. Selling pressure at this level is stronger than buying pressure. Let's say our same stock rallies to $55, pulls back, and then rallies to $55 again before pulling back. That $55 level is the resistance. It's the point where sellers are taking profits or believe the asset is overvalued. Drawing these horizontal lines on your chart is the first and most crucial step in seeing the battlefield where buyers and sellers are fighting it out. A break above resistance can signal a new upward trend, while a break below support might indicate the start of a downtrend. Now let's build on that with something a little more dynamic: trend lines. While support and resistance are horizontal, trend lines are diagonal. In an uptrend, you'll see a series of higher highs and higher lows. To draw an uptrend line, you simply connect at least two of the major lows. This line then acts at a dynamic support level. As long as the price stays above this trend line, the uptrend is considered intact. Conversely, in a downtrend, you'll see a series of lower highs and lower lows. You draw a downtrend line by connecting at least two of the major highs. This line acts as dynamic resistance. The trend is considered to be downward as long as the price remains below this line. Trend lines are fantastic because they don't just tell you the direction of the market. They give you a clear visual boundary for that trend. Okay, we've got our basic building blocks. Let's start putting them together to form some classic chart patterns. We'll start with one of the most well-known, the head and shoulders. This is a reversal pattern that often signals a potential top in the market after an uptrend. It looks just like it sounds. You'll see a price peak the first shoulder, followed by a higher peak the head, and then a third, lower peak the second shoulder. The key to this pattern is the neckline, which is a line drawn connecting the lows between the three peaks. A decisive break below this neckline is the classic confirmation signal that the previous uptrend is likely over, and a new downtrend could be starting. There's also an inverse head and shoulders, which is the exact opposite. It appears at the bottom of a downtrend and can signal a potential bullish reversal. It's the same concept, just flipped upside down. Next up, let's talk about triangles. These are consolidation patterns, meaning the market is taking a breather and coiling up before its next big move. There are three main types. First is the symmetrical triangle, where you have a descending resistance line and an ascending support line, converging towards each other. This shows indecision in the market, and a breakout could happen in either direction. Then you have the ascending triangle. This pattern features a flat, horizontal resistance line at the top and an ascending support line at the bottom. This is generally a bullish pattern. Why? Because it shows that while sellers are holding firm at a certain price, buyers are becoming progressively more aggressive, pushing the lows higher and higher. It suggests a breakout to the upside is becoming more likely. And of course, there's the descending triangle, the bearish counterpart. Here, you have a flat, horizontal support line at the bottom and a descending resistance line. This shows that buyers are holding the line at a specific price, but sellers are getting more aggressive, pushing the highs lower and lower. This often precedes a breakdown below the support level. Triangles are powerful because they show a clear contraction in volatility right before a potential expansion. Another great set of patterns to know are double tops and double bottoms. A double top looks like the letter M. The price hits a resistance level, pulls back, rallies back to that same resistance level, and is rejected again. This shows that the bulls tried twice to break a price ceiling and failed. A break below the low point between the two peaks confirms the pattern and suggests a potential reversal to the downside. The double bottom is its bullish twin, looking like the letter W. The price falls to a support level, rallies, falls back to that same support level, and finds buyers again. It shows that the bears tried twice to push the price lower and failed. A break above the high point between the two bottoms is the confirmation signal for a potential move higher. These are simple, visual, and very effective patterns for spotting potential trend reversals. Now, it's crucial to understand that no pattern is 100% foolproof. These are tools of probability, not certainty. So, how do we increase our confidence in a pattern? We use confirmation. One of the best confirmation tools is volume. Volume represents the number of shares or contracts traded over a period. It's the fuel behind the price move. For a breakout to be considered strong and valid, it should ideally be accompanied by a significant increase in volume. Think about it. If a stock breaks above a key resistance level, but almost nobody is trading it, how much conviction is really behind that move? It could be a false breakout, but if it breaks out on massive, above average volume, that shows strong conviction from buyers and suggests the move has real momentum. Similarly, for a head and shoulders breakdown, you'd want to see volume pick up as the price breaks the neckline. Volume confirms the story that the price chart is telling you. Another key to using patterns effectively is context. A single pattern in isolation is interesting, but a pattern that fits into a larger picture is far more powerful. Zoom out on your chart. What is the longer-term trend? Is the ascending triangle you're seeing forming within a larger, established uptrend? If so, that increases the probability of a bullish resolution. Or is a double top forming after a massive, extended rally? That context makes the bearish reversal signal even more significant. Always consider the bigger picture. Finally, remember that pattern recognition is a skill that takes practice. Don't just look at a live chart, go back in time. Scroll through historical charts of different assets and try to identify these patterns after they've played out. See if you can spot the head and shoulders that led to a downtrend or the ascending triangle that led to a big rally. This kind of backtesting will train your eyes to spot these formations in real time. The more charts you look at, the more intuitive it will become. It's like learning to read. At first, you sound out every letter, but with practice, you start to recognize whole words and sentences at a glance. Technical analysis and pattern recognition are valuable skills for any trader or investor. They provide a framework for understanding market behavior, identifying potential entry and exit points, and managing your risk. It's not about magic, it's about reading the collective psychology of the market visualized on a chart. Thank you so much for joining me today. I hope this gave you a solid foundation for getting started with chart patterns. If you found this helpful, please give this video a thumbs up, and don't forget to subscribe and hit that notification bell so you don't miss our future deep dives. Leave a comment below with your favorite chart pattern or if you have any questions. Until next time, trade smart and stay curious.